$120 per barrel. Write that number down somewhere you can see it clearly. Not because it is a price at the gas pump, not because it will cost you a little more to fill your tank this week, but because for 40 years, without a single exception, every time oil has climbed above this level and stayed there, the United States economy entered a recession within 12 months. Every single time. The 1973 Arab oil embargo, the 1979 Iranian Revolution, the Gulf War of 1990, the 2008 financial crisis, the energy shock of 2022, 5 oil shocks, 5 recessions. The signal has never failed, not once, in 40 years. And as of March 9, 2026, that signal has triggered again. On that day, American and Israeli forces launched strikes on Iran. Supreme Leader Ali Hosseini Khamenei was killed. Within hours, Iranian forces responded with missile strikes targeting multiple countries in the Persian Gulf. By morning, crude oil had blasted through $120 per barrel, reaching its highest level in years. And the markets did not know how to process it. Wall Street, which had been trying to hold the line against a weakening economy since January, suddenly found itself staring at a completely different monster. Here is the part that almost nobody is saying out loud. This oil shock did not come out of nowhere. It was the final ingredient in a recipe for economic destruction that has been building for 18 months. A trapped Federal Reserve, a consumer stretched to the breaking point, a bond market flashing red since the last week of January, a regional banking system already sitting on a $2 trillion time bomb. $120 oil does not hit a healthy economy. It hits a system already on life support, and it hits it with the force of every oil-driven recession in recorded history combined. The 40-year clock is running. The window to act is measured in weeks, not months. And almost no one on mainstream financial media is willing to tell you exactly what that means for your money, your mortgage, your retirement account, and your job. Before we break down precisely how this oil shock destroys your wealth from the inside out, and what the Federal Reserve's paralysis means for every asset in your portfolio, please make sure you are subscribed to the channel so you do not miss the daily updates on this crisis as it unfolds in real time. And comment down below with one word: recession or stagflation. Tell us which outcome you think hits first and why. To understand why $120 oil is not just an energy story, but a total economic catastrophe, you have to understand the transmission mechanism. This is the hidden chain that connects a barrel of crude in the Persian Gulf to the price of groceries on your kitchen table, the value of your home, and the safety of your retirement account. Oil is not just fuel. It is the circulatory system of the modern economy. Every product you buy traveled on a truck, a ship, or a plane that runs on oil. Every factory that made that product uses oil as a direct input in the form of plastics, chemicals, and industrial lubricants. Every farmer who grew the food on your table used oil to power the tractor, the harvester, and the irrigation pump. When the price of oil doubles from $60 to $120, the cost of every single one of those inputs doubles with it. Those costs do not stay with the corporation. They are passed directly to you at the register, line item by line item, until your monthly budget is unrecognizable. The Federal Reserve has a very precise model for this transmission. For every $10 increase in the price of a barrel of oil, the United States economy loses between 0.2 and 0.3% of gross domestic product growth every single year. That sounds like a small number. It is catastrophically large. The United States GDP is roughly $29 trillion. 0.3% of $29 trillion is $87 billion in lost annual output from a single $10 move in oil. Oil has risen by approximately $60 since the beginning of the year. By the Federal Reserve's own arithmetic, that $60 increase has already stripped between $170 and $250 billion of annual economic growth out of the United States economy. And that is before the full effect has worked its way through the supply chain. The transmission takes 3 to 6 months. We are at day 1. But higher oil prices do not just slow growth. They simultaneously destroy the Federal Reserve's ability to respond. This is the trap snapping shut right now around the necks of every central banker in Washington. In January of 2026, the Federal Reserve held interest rates at 3.5 to 3.75%. They had been cutting since September of 2024, trying to stimulate a slowing economy. Wall Street was pricing in 2 more cuts this year, one in April, one in September. BlackRock, managing $11.5 trillion in assets, was publicly warning the Fed would pause until a new chairman was confirmed. The CME FedWatch tool had April rate cuts at a meaningful probability as recently as 2 weeks ago. $120 oil has annihilated every single one of those expectations. Here is the mathematics of the trap. If oil stays at $120 per barrel for the next 6 months, United States consumer price inflation will rise from 2.4% in January to above 3% by year-end. That is a 25% increase in the inflation rate driven by a single commodity. A Federal Reserve fighting to bring inflation back to its 2% target cannot cut interest rates when inflation is surging 25% above that target. The cuts are gone. Every single one of them. But the other jaw of the trap is just as lethal. Consumer spending represents 70% of the entire United States economy. Every dollar that goes into a gas tank is a dollar that does not go to a restaurant, a hardware store, or a monthly mortgage payment. At $120 oil, the average American household will spend an additional $2,400 per year on direct energy costs alone, before indirect cost increases filter through to groceries, clothing, and utilities. That is $2,400 extracted from every household budget, multiplied across 130 million American households. The aggregate demand destruction is staggering. It is a simultaneous inflation shock and a demand shock, and the Federal Reserve has no tool that addresses both conditions at the same time. This is the trap. To fight inflation, they need higher rates, which accelerates the recession. To fight the recession, they need lower rates, which accelerates the inflation. They are mathematically paralyzed. Beneath that paralysis sits a $36 trillion national debt that makes the paralysis permanent in a way that was never true in any previous oil-driven recession in history. We are living through something that has never happened before in the 40-year record. But here is where it gets worse. Because the cascade of failures that $120 oil sets in motion does not end with consumers and the Federal Reserve. It moves through the economy in layers, each one amplifying the damage of the layer before it, until the entire system is under simultaneous stress from every direction. The first domino is the airline and logistics sector, the physical infrastructure that moves the economy. Jet fuel and diesel account for between 20 and 25% of operating costs for the airlines and trucking companies that hold the supply chain together. At $120 crude, the average large American carrier faces $4 to $6 billion in additional unbudgeted annual fuel costs. They have 3 choices. Raise ticket prices dramatically, cutting travel demand and triggering cascading losses in hotels, convention centers, and tourism-dependent businesses. Slash routes and capacity, triggering layoffs and destroying the business travel market that sustains commercial property values in major cities, or absorb the losses, watch their credit ratings collapse, and breach the financial covenants on their debt facilities. In the 1973 oil shock, multiple major carriers went bankrupt. Pan American World Airways never fully recovered. The pattern does not change because the calendar does. But the story does not stop there, because when airlines pull back capacity, the downstream impact on commercial real estate is immediate and severe. Business hotel occupancy falls. Convention center bookings are canceled weeks in advance. Hotel properties that were barely cash flow positive at $60 oil become deeply negative at $120. And those hotel properties, many financed with the same balloon payment loans already defaulting in the office sector, become the next wave of troubled assets flooding into regional bank balance sheets that have no room left to absorb them. The second layer is the trucking crisis. 3.5 million truck drivers move approximately 70% of all freight in the United States. When diesel spikes toward $5 per gallon, the cost of moving every product rises simultaneously. The grocery store, the pharmacy, the hardware store, the auto dealership, everything arriving on a truck becomes more expensive at the exact moment the consumer has less money to spend. This is the inflationary ratchet the Fed fears most. Manufacturers renegotiate freight contracts annually. Retailers lock in prices for months. The oil spike of today becomes the grocery bill increase 6 months from now, and it stays elevated for 18 months after the oil price eventually falls. Once the ratchet clicks, it does not release easily, but the real danger lies one layer deeper still. Because $120 oil does not just hurt businesses that consume it. It detonates the financial instruments that were built on the assumption that oil would stay below $100 per barrel. In the global derivatives market, trillions of dollars of contracts exist in the form of swaps, structured notes, and options representing bets that oil would stay below certain levels. These contracts are held by airlines, utilities, manufacturers, and the investment banks that issued them. When oil breaks $120, many of these instruments cross their trigger thresholds and generate catastrophic losses overnight on the next settlement date. Margin calls that must be met in cash immediately, or the position is liquidated at maximum loss. The institutions receiving these margin calls are often the same institutions already sitting on hundreds of billions in unrealized losses from the commercial real estate crisis and the 2022 to 2025 rate hike cycle. When you force an institution already stretched to the edge of its capital cushion to post additional margin, you do not just hurt that institution. You force it to sell assets at distressed prices into a market where everyone else is trying to sell simultaneously. Asset prices collapse, volatility explodes, and the financial system begins the same sequence of correlated failures that turned a housing problem in 2007 into the complete global systemic meltdown of 2008. Oil derivatives can replicate that dynamic at these prices. The system is fragile. $120 is not an ordinary number. It is the threshold where systemic fragility becomes systemic failure. The third front opening in this war is the pension fund crisis. Public pension funds in the United States hold approximately $4.5 trillion in assets meant to fund the retirement security of 43 million public employees. These funds are required by their charters to hit assumed rates of return of between 6 and 7% annually. They achieve this through a combination of stocks, bonds, and alternative investments, including real estate. But in the environment $120 oil creates, all three asset classes are under simultaneous pressure. Bonds lose value as inflation forces rates to stay elevated. Stocks lose value as economic growth contracts and consumer spending falls. Commercial real estate loses value as higher long-term rates crush valuations. They fall together, not in alternation. The diversification that pension actuaries built their models around simply does not function in an oil-driven stagflation. When a pension fund misses its assumed rate of return for 2 or 3 consecutive years, the technical term is unfunded liability. The fund does not have enough assets to pay the benefits it has promised. That gap must be made up through higher contributions from the state or city that sponsors the fund, which means higher taxes on residents already crushed by the oil shock, or through benefit cuts to the retirees who depend on those payments, which means political crisis, cascading into social instability, or through both simultaneously, which means fiscal catastrophe at the municipal level, arriving just as the recession is at its deepest point. The fourth layer is the municipal and state budget crisis that follows within 12 months. When unemployment rises and consumer spending falls, income tax revenues and sales tax revenues decline sharply. When commercial real estate loses value, property tax revenue from commercial properties collapses. When corporations cut earnings, corporate tax revenues disappear. All of these revenue streams decline simultaneously at exactly the moment demand for government services, unemployment benefits, food assistance, emergency housing support is rising most rapidly. Cities and states face structural budget gaps that force service cuts and tax increases at the worst moment in the economic cycle, amplifying the recession further rather than cushioning the blow. This is the full cascade. Oil shock to consumer destruction, to Fed paralysis, to airline and logistics failure, to derivatives explosion, to pension fund stress, to municipal budget collapse. Each layer feeds back into the others, tightening the spiral with every turn. It is not a linear sequence with a beginning and an end. It is a self-reinforcing loop that builds its own momentum once the trigger is pulled, and the trigger was pulled on March 9th, 2026. This crisis is now at your door. Not at the door of oil executives and geopolitical analysts in Washington think tanks. At your specific door, with your specific mortgage, your specific retirement account, your specific job, and your specific savings. If you have a variable rate mortgage or a home equity line of credit, you are already directly exposed. The transmission from oil spike to inflation, to Fed paralysis, to sustained high long-term rates did not take months. It happened in the bond market this week. Your adjustable rate payment will reset higher at the next adjustment date, and at current oil prices, relief is not coming in the next 2 quarters. If you have a fixed-rate mortgage, your home value is under threat even if your payment is stable. Rising long-term interest rates compress home valuations through basic mathematics. A home worth $400,000 at 5% mortgage rates is worth approximately $320,000 at 7% mortgage rates. The math does not require a housing market crash to produce a significant loss of your primary household wealth. It only requires rates to stay higher for longer, which is exactly what $120 oil produces. If you have a retirement account in the standard 60 and 40 portfolio, 60% stocks and 40% bonds, you face the same dual threat that destroyed retirement values in 2022, but starting from a weaker economic position. Bonds lose value in inflationary environments. Stocks lose value as growth slows. They fall together. Your diversification exposes you twice rather than protecting you once. The 60-40 portfolio was built for a world of stable prices and responsive central banks. We do not live in that world anymore. If you work in any consumer-facing sector, and 70% of the United States economy is consumer-facing, your job security is at risk within 2 quarters of sustained $120 oil. Retail, hospitality, tourism, automotive, residential real estate, construction, entertainment. These sectors face direct demand destruction as the oil shock extracts spending power from the consumer economy. The corporate response sequence is standard. Revenue misses in the first quarter, hiring freezes in the second, layoffs in the third, rising unemployment in the fourth. The recession that economists are still debating becomes undeniable 12 months after the signal fired. Your bank account is not a vault. It is a highly leveraged balance sheet that holds your deposits as a liability while betting them on loans and securities now under stress from multiple simultaneous directions. The commercial real estate exposure, the unrealized bond losses, the oil derivatives, the slowing economy. Your local bank's vulnerability to all of these is not visible when you check your balance on your phone. It is visible only in the quarterly FDIC filings that almost no one reads until after the doors have closed on a Friday evening. The first bank failure of 2026 has already happened. The pressure that caused it is accelerating, not diminishing. The window of opportunity is narrow and it is closing. The Federal Reserve's March meeting is in 8 days. They will hold rates because the trap has no exit door. They will issue a statement filled with the language of careful ambiguity. Data dependent, monitoring elevated uncertainty, remaining vigilant. They will not say that the 40-year recession signal has fired. They will not say that the consumer is out of reserves. They will not say that $120 oil has made every rate cut projection for 2026 mathematically impossible. They will speak carefully and vaguely, because acknowledging the reality of the trap they are in would accelerate the very panic they are trying to delay. But delay is not prevention. Every time in history that a central bank has tried to delay the reckoning from a major oil shock, the delay only made the eventual correction more severe. In 1979, the Fed hesitated on rate increases while calling inflation transitory. By the time Paul Volcker acted, rates had to reach 20% to break the spiral. The recession that followed was the deepest since World War II. The lesson of 40 years is not that central banks are incompetent. It is that oil shocks move faster than institutional responses. By the time the response is fully calibrated, the damage is already structural. Do not be the last person standing outside the bank on Monday morning when the doors do not open. Capital controls, deposit restrictions, and banking holidays are not conspiracy theories. They are documented historical responses to financial crises. The United States imposed banking holidays in 1933. Cyprus implemented deposit haircuts in 2013. Greece imposed capital controls in 2015. Every one of those events was preceded by official statements that the banking system was sound and deposits were completely safe. Every single one. By the time the statement changed, the window had already closed and the damage was done. The first thing you must do immediately is review your portfolio for maximum vulnerability to this specific shock pattern. Consumer-facing equities, airline stocks, highly leveraged retailers, and home builders will face the sharpest initial impact. If your exchange-traded funds or mutual funds are heavily weighted toward these sectors, now is the time to rotate toward energy producers, commodity-linked assets, defense contractors, and utilities, sectors that benefit from or are insulated from the oil shock environment. This is not a long-term reallocation recommendation. It is a tactical defensive move against a 12-month recessionary cycle that the historical data says is now highly probable to unfold. The second thing you must do is address your variable rate debt with urgency. Any adjustable rate mortgage, credit card balance carrying high interest, or home equity line of credit must be converted to fixed rate terms or prioritized for payoff before the next rate adjustment period. $120 oil is locking in a higher for longer interest rate environment that will make variable debt exponentially more expensive over the next 12 to 18 months. Every week you delay this conversion is a week of compounding unnecessary risk. The third thing you must do is evaluate and build your cash position deliberately. In the 2008 financial crisis, the investors who emerged with the greatest gains were not the ones who stayed fully invested through the worst of the downturn. They were the ones who had cash available in March of 2009 when every major asset class was on sale at generational discounts. Cash is not a return. Cash is power. It is the ability to acquire distressed assets at a fraction of their pre-crisis value when the panic reaches maximum intensity. Build those reserves now, while the system still allows you to move freely and without restriction. The fourth thing you must do is scrutinize your banking relationships with new rigor. The Federal Deposit Insurance Corporation insures deposits up to $250,000 per depositor per institution. If your deposits at any single regional bank exceed that limit, you are exposed to losses that go beyond what any government guarantee covers. With regional banks already under pressure from the commercial real estate crisis, the derivatives stress, and now the oil-driven economic slowdown, the probability of additional bank failures over the next 12 months is rising, not falling. Spread your deposits across multiple institutions. Prioritize systemically important banks with explicit government backing. The distinction between institutions that are too big to fail and those that are not is the most important banking distinction you can make today. The fifth thing you must do is address your direct energy exposure in your household budget. If your monthly cash flow is heavily dependent on gasoline, natural gas, or heating oil, $120 crude is a direct and immediate drain on your personal finances that will compound every month it persists. The time to investigate efficiency investments, alternative arrangements, or renegotiated contracts is now, not when the bill arrives and the budget is already broken. The 40-year record is not comfortable information. It is not the kind of analysis that gets distributed by mainstream financial media, because acknowledging it would create the very panic it describes. But the record exists. 5 shocks, 5 recessions. The same transmission mechanism operating the same way every single time. Higher oil costs drain consumer spending power. Inflation rises, trapping the central bank. Economic growth slows, and unemployment follows. The recession arrives 12 months after the signal fires, just as the official forecasters are finally acknowledging what the data showed from the beginning. The difference this time is not that the mechanism has changed. The difference is that the United States economy is entering this oil shock in the weakest structural position it has occupied in any previous oil-driven recession. The national debt at $36 trillion, with $1 trillion, equal to 14% of all federal spending consumed by interest payments alone. That interest cost has tripled in 5 years. The Federal Reserve with 3.5 to 3.75% as its starting rate, far less room to maneuver than before any previous oil shock. The consumer at record debt levels, with $1.28 trillion in credit card balances and delinquencies rising every quarter. The regional banking system fragile from 2 years of commercial real estate pressure. Every cushion that existed in previous oil shocks is thinner today. The storm we have been warning about is not on the horizon. It is overhead. The data is not ambiguous. The signal is not theoretical. The 40-year clock is running. The question is not whether the recession is coming. The question is whether you will be positioned to navigate it and emerge intact on the other side. Subscribe to the channel and turn on the notification bell so you are alerted the moment the next development breaks in this oil crisis, the Federal Reserve's March response, and the broader economic sequence that is now unfolding. Share this video with anyone you know who has savings in the market, a mortgage, or a retirement account, depending on stable economic growth continuing into next year. The algorithm does not distribute hard economic truths willingly, so we need your help to get this information to the people who need it most. Together, we can navigate this collapse and emerge with our wealth and our financial freedom intact.